everybody, and welcome to the latest webinar with me, Andrew Dawkins, and
myself, Rachel Blackhall.
Lovely to have you with us today, and thank you again for joining us. So today we're going to be discussing...
Well, Craig's actually going to be discussing the world of accountants and tax. A bit of a shorter one today. We're not going to do as much since it was only a couple of weeks ago since our last one. So I'll hand over to Andrew just to do another brief market update. And then hopefully technology is on our side today and Craig Allison will be joining us from Barrie Scott Co.
Super. Lovely. Thank you very much. So as Rachel was saying, it's only a couple of weeks ago since the last review. And I think the major thing that's happened since then has been President Biden being able to get through the stimulus package for $1.9 trillion, which is, there we are. Yeah, it's a huge number of zeros. Quite big indeed. And this is something that Trump initially was trying to get a $1 trillion stimulus package going and failed spectacularly. But obviously the effects of the COVID pandemic have meant that it's easier to put through both houses, as well as the election result going his way as well. So that's set to pump a huge amount of money into the US economy. And as we know, we're all very heavily dependent on what happens in the US. So that will filter through to the rest of the world as well. So that was the big thing really for the change for the last couple of weeks. The other thing is that the debt level continues to increase, but at the moment the market is still being able to absorb the debt that's coming into it. It brings fears about inflation later in the year, and that then spooks investors. And we see that still the fixed interest rate, so that's lending money to people and governments, is actually starting to fall in a lot of sectors as inflation is factored in. Because if people think inflation is going to be an issue, then lending money to a company, say with a 2% return, but if inflation is at 3%, it doesn't look that attractive. So the money moves away from the market. It's going to be a good run for us for the rest of the year as soon as the pandemic gets brought under control, and the UK looks like it's going to be set to benefit perhaps quicker than most because of the way that the vaccine has been rolled out. So again, quite a bit of new money coming into the UK. And as you know, we're sort of heavily exposed to the UK, but doesn't have been for a number of years because of the good returns that they bring us. So I think the future is certainly bright. Again, we would look at people to say those with the lower risk profiles, cautious and defensive, with the higher fixed interest element. We do urge perhaps some of our viewers to go up the risk profile slightly and reduce the fixed interest exposure. But if you need more information about that, just please get in touch with us because we're happy to talk that through to you. And I think really that's as much as we want to say just at the moment, because a lot of what we said really applies to the last seminar and the seminar before.
Yeah.
So
wasn't that long ago? So yeah, not much changes in the meantime. So if you bear with us now, we will hand over to Craig, and hopefully you can all hear him loud and clear.
Thanks, Rachel. Thanks for having me. And we'll be looking at the various tax effects of the latest budget announcement. And we'll specifically be talking about that relates to in Scotland. The main rates and allowances are very much the same throughout the UK, but minor differences within from Holyrood versus Westminster. There is one big issue dependent on in Scotland related to Scottish stamp duty, which is land and building transaction tax in Scotland, which I'll come on to in a little while. The main thing to take from the budget recently has been really not very much has changed. It's more or less frozen for the next 5 years now. There will be no change to the rates that you pay tax or the thresholds at which you do so, other than an inflationary one to end in the next financial year. There have been some allowances in respect of the COVID pandemic to make things easier especially for business customers, which is what HMRC call taxpayers, which means that we've got more flexibility to use business losses that might have arisen in this time, which are now able to be carried back 3 years as opposed to the 1 year that it was previously. There have been no major changes to the capital taxes, inheritance tax or capital gains tax, in much the same way. The all the main reliefs related to inheritance tax still apply. There was some speculation before the budget that the Chancellor would be looking to raise money from increasing those specific headline taxes, which didn't happen. And largely, we are going to be much the same as it's been for the previous few years. The tax rate specifically for savers, the allowances available in terms of dividends and on bank interest, again, remains unchanged. Doesn't likely to be much movement in that planned. Although bearing in mind that with all these effective freezes, when we freeze the allowances and the rates, if we're not adjusting for inflation, then that technically means that they are going to be worth less moving forward. Although that could be what inflation is going to be in the next few years, as anyone's guess as well. So pension remains frozen. The lifetime allowance remains unchanged, as does the maximum contribution levels. Again, we were anticipating there might be a reduction in that level put forward. That doesn't seem to have happened. The pensions going forward remain a good investment for the self-employed. One of the best ways, in fact, to reduce their own tax liabilities. Applies to employees too, assuming attention paid to their lifetime allowances. Also a good way for employers to reward employees at this point is with pension contributions additional. The auto-enrolment scheme related to employees remains ongoing. There have been some indications of some changes to that in respect of the COVID, but unfortunately that hasn't happened. And the one thing to note is that obviously employers are still liable for the employees' auto-enrolment pension contributions while on furlough, which does make a bit of a consideration for their cash flow activities. So specifically for employee benefits then, we've continued to move on to the usual plan of promoting the green agenda with low emission vehicles, with electric cars, vans. Now, the way that has been implemented is to reduce the benefit in kind charges that would normally be payable to those. Now, for specifically van benefit will be removed on zero emission vans, that's electric vans, and which means the employer will no longer have, the employee will no longer have to pay for the use of it via their tax code. The employer will no longer have to pay the national insurance charge on top of it. It means that for company cars remain then the best option to be, if they're going to be provided for employees, it remains that having the electric low emission is the very best option. Assuming that the conditions are met. Obviously the cars in question tend to be more expensive at this point, and the infrastructure necessary for them is somewhat difficult. There are specific reliefs available for employers who install electric charging stations at home at their premises, which somewhat defrays that. There's been some confirmation on the various issues arising from COVID testing on the provision by employers of testing kits of personal protection of equipment, and basically to confirm there will be no attempt to effectively tax the employees on a benefit in providing that. That seemed unlikely last year that would happen, but technically it was within the rules at that point. So that's been since clarified that won't give rise to any. And the other one in that respect is the extension to the home working allowance, where employees are working from home, and a equipment supplied for that is now being extended to April 22. So that's certainly something that those affected, those working from home, can make sure that they're either being reimbursed or they are claiming that via their tax code from HMRC. Obviously, in general, employees looking at their tax code is a pretty good thing to do annually anyway. Make sure HMRC doesn't always get it right in that respect, and if it can be worthwhile investigating that to check that you are being credited for everything that you pay, especially if you don't do a tax return. If you don't do a tax return, you're relying on HMRC getting that right for you. So you can do that by logging into your personal tax account these days. It's actually quite painless now, and especially for those employees who happen to have benefits, cars, the like, it's a worthwhile exercise doing at any time. There's been various changes to the cycle to work scheme, and again, it's more of a relaxation because of COVID, where there were certain requirements on how often you had to cycle to work, basically, which has been relaxed because you can't no longer do that. Again, it's a 5th of April 22. They're talking about relaxing it too, but again, it's probably a marginal interest to a few people. Although again, if you're into cycling, then the cycle to work scheme, the employee pick schemes are very actually good ways of buying that. And obviously the main impact on employees at the moment is going to be the coronavirus job retention scheme extension, which is currently saying September 21. There are various tiers within that will reduce the contribution from 100% and require payment from the employer. It's more flexible than it was this time last year. It means that employees it doesn't have to be all or nothing. It's more to just sort of bridge the gap between allegedly June, when we're hopefully all going to be back to normal or thereabouts, and September, when business can hopefully return without having a sort of cliff edge that falls off. I don't expect it will be extended much beyond September 21. I think they're fairly clear on that. There's some worry over the Scottish Government, again, in terms of if England's plan is more, or England and Wales and the rest of the UK, in fact, is more plan is line in the sand's been drawn, there's no going back from it, they're going to proceed with that. I'm not sure how that ties in with the Scottish Government's approach of returning to tiers in terms of what financing will be available and what options would be available to somebody who was still in the position of having to furlough when, after that time, if that's a possibility. We hopefully will know more soon about that, but to be honest, it's like all these other changes as well, is that they come fairly quickly, very little notice, and so it's probably, I'd certainly be planning on it being September 21 anyway. So I mentioned before that one of the biggest differences between us and Scotland, and subject to land and building transactions tax instead of the rest of the UK and stamp duty, is that the holiday on stamp duty has not been extended in Scotland. It expires at the 31st of this month, whereas in England it's been extended onwards. Now, that's it relates to properties that are over 150,000 anyway. So it's certainly going to make buying houses in Scotland more expensive from the end of this month. There's Scotland, we also have our additional dwelling supplements and various other ways that we might like to make it complicated, which means that it's we haven't really been given much of a reaction on why we didn't extend it in the same way too, other than we just have to do our own way and be different. It might even just justify the existence of the separate Scottish tax office that's been set up to do it. That might change. I I get that a lot of people are particularly thrilled about that idea, but it's it's definitely one of the biggest differences we've seen so far between the taxes that are applied in the rest of the UK. I wasn't going to go into too great detail on the business taxes because I'm we're primarily talking about individuals here, but I thought I'd go over some of the major changes that are extended. The biggest one being the extension to the corporation tax, which is now going to be 25% from April 23. Now, it's not going to be 25% for everyone. There's a what we call a small profits corporation tax rate that's currently the same at 19%, which will apply up to 50,000 then. So we're back to the case we had a number of years ago where we've got a marginal rate between the 19% and the 25% total rate. I expect that probably be, if we're expecting Amazon to be paying 25% corporation tax, I don't think we're going to get very far with it. But then the smaller businesses probably are going to see a minor uplift in that by the time that that rolls around. Although to some extent that's been put off by we've got now a 130% super deduction on capital allowances. That's the plant equipment bought by a business. Now, we're waiting on the detailed rules for this because immediately I thought that if I'm getting 130% to claim on additions of fixed assets, then everything's going to be a fixed asset. So staplers and punches, and so if I spend £10 on a stapler, then I can claim £13 tax deduction for it. So I'm waiting to have that idea shot down in flames by the de minimis limit that's put down onto it or so far. Otherwise, I can certainly see our accounts becoming a lot more in depth for that. We can expect that we'll hear more about what actually qualifies, but we're at the moment I'm taking it will be all the usual plant equipment, commercial vehicles, computer equipment, and so forth. So no real restriction. There's some question over exactly how it's going to interact with the annual investment allowance you currently get, which is also effective 100% claim on fixed asset additions. So a business who can expect to be investing in capital additions can hopefully get a good tax benefit from this that will outweigh anything that will pay in additional taxes for a good number of years. Especially there's also been a package of recovery finance available, which seemed to stand on top of any current support, any bounce back loans. So businesses who were looking to borrow that money to invest in capital equipment could do very well out of that. The low cost of the financing, the tax benefits applied, although it's again, that would be dependent on when we can expect to see a relaxation of the restrictions that would allow such an improvement. There's been some temporary changes to the carryback of losses I mentioned. It's much the same. We can carry back losses that are made between April 20 and March 22 now, and so usually you can carry back 1 year. Now we're going to be able to carry a further 2. So that will hopefully help any businesses who had a particularly bad time recover some money from taxes they'd already paid. VAT has remained frozen at the same rate, which and looks like I think they're saying for the next 4 years, which again is effectively a decrease in the value of it, but it means that businesses who are turning over less than 84,000 will not have to register. It means that there's probably a few who'll be caught by that small change in terms of, because it would usually be inflated every year. At the end of that period, you'd probably be talking about more like 90,000, so maybe a bit more. So businesses, smaller businesses who might not normally be caught by VAT registration might find themselves in it in a few years. The main rate of VAT cut, the 5% rate created for the hospitality industry recovery has been announced. It's been extended to March 22. So it's hospitality and tourism. It's more or less the same operation as it was. So it's for it doesn't apply to alcohol, unfortunately. So we're still paying the full price on that. But the 5% rate applies to food. So that's not intended to be a benefit to the consumer as such. It's more to support the business. So the consumer can expect to pay the same end price. It's just the business doesn't have to give quite so much back to the tax office. I know that there's been some confusion with that, because some of the bigger companies immediately did discount their prices to do it, but that wasn't the intent, although I'm certainly not going to complain. There's been some confirmation on the taxability of any grants that may have been paid, received, in terms of, and basically just saying that they're all taxable. It seems fairly logical to give people money and then require them to pay tax on it later, but that's the way it was always going to work. It more or less firms up, especially for anyone who received the self-employment grants, on exactly how they are going to be included in tax returns going forward, confirming that they're going to be subject to national insurance and the like. So they gave it to you last year, they'll be looking for it back next year. So one of the things they were talking about is HMRC in particular are being granted some new powers to try and chase information down. Honestly, it doesn't really amount to a lot. It doesn't seem much different from what they get just now, and I'm sure that it's something called a financial information notice, which more or less sounds exactly the same like they do it just now. It's some talk about it being in aid with international cooperation, which I'm sure is hopelessly optimistic, but good luck to them. I can't imagine it's going to have much impact on anyone. And is that the last slide for that one, Rachel?
That's us. So thank you very much. I think we've had a few questions in, so I'll pause for just 1 minute, have a quick read through those, and be back with you in just a second.
Have you answered the question? Have you answered the question again?
Oh, I did forget to mention that at the start. So while I'm reading through those who had managed to figure it out, if you want to just type your question, I think there's a box on the side, a chat facility. So yes, if you have anything you want to ask, pop it in there now. Thank you.
Good. Welcome back, everyone. I didn't realise it was me.
So we were just looking at each other there. So I'll ask the first question then, Andrew.
Okay, if you would.
So Craig, what can someone in employment do to limit their tax exposure?
So if you're in employment, you've got a full-time day job, you get your salary and they take the tax off, then your options are far more limited than you are self-employed. But there certainly still are things that you can do. Pensions arrangements, even if you have an employer pension arrangement at the moment, obviously having a private pension arrangement can be beneficial. Downside is obviously it requires an actual cash payment, so you're effectively by reducing your tax bill, you're having to pay money away. But as with all pensions, the idea is that it will grow over time more than you could hope to have it and sitting in the bank account. So on retirement might be a very good option. Certainly it's a good option as well where you're into the realms of the more than £100,000 earnings, where you start to lose the benefit of your personal allowance. Even a relatively small pension payment can be a good idea there. Gift aid, charitable donations, if you're charitably minded, is also another way that you can reduce your tax bill. Again, it involves giving money away, but if you're going to support your charities anyway, if you're going to make donations to them, then doing under the gift aid covenant means that you can claim your tax relief for your higher rate taxpayers. Employee related expenses is another one. If you incur expenses in doing your job, it's very similar to the working from home at the moment. But if you're required to incur certain expenses that your employer doesn't reimburse you for, then having that either claimed into your tax return or adjusted via your tax code can be beneficial. There are some specific professions and jobs have flat rate allowances that have been agreed with the revenue to There are professional subscriptions that perhaps may be appropriate, even some equipment and some. If your employer reimburses you for business travel, if they don't reimburse you at the revenue approved rate, you can reclaim the difference between what your employer pays you and what the revenue pays you, which is if you're doing a lot of business miles, that can certainly add up as well. And there are slightly more risky approaches related to specific types of investments on the EIS and so on. These are something you'd obviously want to take special advice beforehand, and are far inherently more risky than any other investments, but come with good tax opportunities in that.
Excellent, thank you.
Lovely. Question 2. As a business owner, what is the best way to withdraw money from a company? So that's from Andrew.
Andrew Dawkins. Was it?
Well, I think cash in a brown envelope's probably not the way anymore. Assuming a limited liability company in the usual way, then dividends remain the most efficient in terms of the individual. There is the difference between the two, paying out as a salary and paying out as dividends, is not as great as it used to be, but it's still worthwhile. Assuming you use your normal salary of the core earnings limit, topped up by dividends. Additional cash is out with the business then is more difficult. You want to make sure that the business is making appropriate claims to pay you for as much as possible. So making sure that you use the allowances available to their extent. There are for business directors, there are what's called trivial benefits, which mean that you can pay yourself up to £300 of £50 up to items up to £50 that aren't directly transferable into cash. So I would normally say that the business could buy you a shirt, for instance, but I don't imagine you'd wear a shirt that would cost less than £50. So which is, but it's also again, it doesn't sound a lot of money, but added up year on year, £300 a time for each. Trivial benefits also apply to employees as well. So it's just one of the ways that you can get something out allegedly for nothing. Again, for pension contributions remain one of the best ones, having the company make the pension contribution for you. Then the company gets a tax deduction on it, but that's not quite paying you cash. There's a calculation to be done on cars and things, whereas if it's beneficial for the business to buy a car and provide it to you rather than you withdraw the money from the business to pay for your own, and that very much depends on the factors of what sort of vehicle we're talking about and what sort of business mileage. But there are instances where it can be worthwhile having the business do that in the first place, which then means that you're not having to pay for the payments of the vehicle out of your own taxed income, which can be doubly effective. Normally, I would say things like commercial vehicles, but I can't imagine Andrew buying a Ford Ranger either.
Thank you. So I'm assuming that you deal a lot of your clients are from a variety of different industries. Have many of your clients been affected by COVID?
Definitely, and unfortunately, a lot have been negatively impacted. A lot of the hospitality businesses are going to struggle and are going to struggle going forward. Many other related the suppliers to it, the tradesmen who are associated with maintaining their equipment are all going to feel the same impact on that. There are people who are doing well out of it. There are some of the smaller hospitality venues, the smaller cafes who've been able to adapt to open are certainly holding their own on that one, and hopefully that will continue. Some other many of the sort of the joiners, the gardeners had a particularly good time, especially over last year when nobody could go anywhere and do anything. A lot of people spent a lot of money having their gardens done, having summer houses and the like. So that proved to be quite good for many of the smaller businesses in relation to that. We can, but for most of it, we're going to have to wait and see what the eventual fallout is. As long as the government funds are still being paid at the moment, it's hard to say who exactly is going to be able to come out the other side. But I'm hopeful that if the restrictions and the easing proceeds as planned, and we can get back to some sort of normality. Is it the 26th of April? Then hopefully that will put people mind at rest in terms of what happens. There's the expectation that there might be a very good period of trade immediately following those relaxations. It will depend on exactly what we're allowed to do, but I can expect that hospitality will have a very good time at that point, as will the main retail and so forth, not to mention hairdressers and barbers, who I'm definitely sure are going to have queues out the door.
Probably won't make much money from me, though. Thank you very much, Craig. We have a final question from Stuart. Craig, were you a pupil at Denny High School?
Denny High School? No, I'm afraid I wasn't, no.
No, definitely Craig.
So we're trying to impersonate you. Right. So, thank you very much for all those questions, and thank you very much, Craig, for joining us today. That was very, very interesting. Good to have the accountants with us, and we work closely with accountants, solicitors, and I think it's always useful if you've got any sort of queries at all, run them past us, and we'll put you in touch with Craig. And it's always good to get that professional advice. It can save you a lot of money, as we've seen with clients over the years. Okay, you have to pay for the advice, but sometimes it can save you big money and a lot of trouble as well. You don't get caught by the taxman. And finally,
here we go. Andrew's going to take great pleasure in this one. So last month's webinar, when we thought you slipped up and said bigly, not one to let it go, had to do some research. Turns out it is a real word used by Donald Trump, famously.
He's one of my heroes.
So yeah, we couldn't let it go without letting you all know. Andrew had to set the record straight there.
So try and get that word into your speech today at some point. Bigly. We like bigly. Speaking of bigly, we're going to move on from bigly monthly seminars, and we're going to be going to quarterly for the next webinars onwards. Really, the idea is to try and keep the seminars fresh and interesting and relevant. We've found that over the last 2 or 3 months we are repeating quite a bit because, funnily enough, there's not a great deal that happens in the world of finance.
There's a lot more to report. When we first started this at the initial COVID volatility and things, there was a lot more to talk about, but things have certainly settled, and we don't want to be just repeating and rehashing the same things. So we're thinking about moving it to quarterly, but obviously if anything changes in the world of investments, then we'll certainly look to do ad hoc ones in between times if there's anything we want to share.
Yes, and we are going to do the monthly market updates. We'll put the video out there, so we'll share that with you as well. So you will still be able to enjoy hearing Rachel and I banter away. Any ideas for inclusion in webinars, please let us know. And if you're permanently opposed to quarterly and you prefer monthly, let us know what you'd like us to talk about. And it'd be nice to hear from you.
Yeah, indeed. So I think that's us for today. Thank you all once again for joining us, and we will speak to you all soon.
Thank you very much. Stay safe.